My name is Daniel Gorfine. I'm the Director of Financial Markets Policy and Legal Counsel at the Milken Institute. My policy work focuses on new capital access tools, which includes crowdfunding and peer-to-peer lending. And more recently, I'm looking at fintech innovation and how that meshes with policy approaches and different regulatory frameworks. So today we have an incredible panel of leading legal experts who will help us work through, and I kind of see this in three different parts. First, what's the existing legal regulatory structure when we talk about new capital access tools? Second, what are the key legal considerations for market participants? And finally, where may we be going in the future from a legal and policy perspective? Before we jump into that, let me set the context here. We're talking about crowd investment tools, whether they be crowdfunding or peer-to-peer lending. And much of that is driven by the new the Jobs Act legislation, I guess I can't call it new anymore, as well as certain financial market innovations. And I would argue that there's three key threads that kind of drove either the law or this innovation. One is, since the financial crisis, we've seen a retreat of traditional early stage equity investors, at least in particular geographies or sectors, and also decreases in small business lending from traditional banks who, for a variety of regulatory and market reasons, have been moving out of that space. Second, we've been trying to figure out and grapple with how new communications tools and the internet can help connect market participants in a different way. And finally, there's been this broader movement to democratize financial and investment opportunity. So I would say that these three threads really feed what we're seeing in the markets. But there's no question that these financial market innovations are banging up against, at times, legal frameworks that were created decades ago and did not contemplate the role of the internet and modern communication tools. So with that, let me get into the discussion part here with our panelists. You have everyone's bio here, but we have Doug Ellenoff sitting at the end here. We have Brian Korn, Anthony Zeoli, and Keir Gumbs, closest to me. So to get started, Anthony, let me turn to you. Talk to us a little bit about the current regulatory and legal framework for Title II of the Jobs Act and how it's been implemented through Rule 506C.
Sorry, can you repeat? No, I'm just kidding. No, Title II is the active crowdfunding legislation right now, and that's what the majority of the portals are working with, either Title II 506C or the other use the 506B private letter ruling. So that allows the general solicitation to accredited investors. So that's what the majority of the platforms are using if they're not using some type of score offering or some type of limited offering that allows other solicitation. That is the basis for what you're seeing as far as the general solicitation of platforms today.
Great. No, that's great. And for lawyers, we're keeping our remarks here short, so this is impressive. Doug, let me turn to you. Can you fill us in what's going on, or maybe not going on, with Title III crowd investing, but also talk to us a little bit about the intrastate crowdfunding laws that we've seen enacted in a number of states?
If the objective is to keep it short, I think Title III will achieve that, notwithstanding that it was signed into law and that the SEC has proposed rules out as of October 23rd of last year that comments were due as of February this year. We're sitting idle and there's nothing going on with it. So that pretty much sums up Title III, unfortunately. As a response to the inertia in Title III, a lot of the state politicians and commercial people have pushed for there to be intrastate crowdfunding, which is a derivative of the federal rules. And in, I think it's 12 or 13 states at this point in time, you have intrastate rules that have been passed and are effective, although there's limited activity, truthfully, happening in those states. And then there's a similar number of states that have initiatives that are winding their way through the political process. And I think the conclusion is simply that people want to see Title III happen, and this is their way of acting out.
So just to follow up on that, why do you think it is that we're not seeing a lot of state-based activity?
Well, the rules are not exactly like Title III, and I'm a big believer that the Title III rules, notwithstanding some imperfections, actually are quite enlightened. The staff members at the SEC spend a tremendous amount of time working on them, and I think they actually are a very healthy balance between investor protection and capital formation, particularly the social media aspects of it. The intrastate rules, while they accommodate for versions of Title III, $1 million raises and caps on the amount of investors, they're limited in terms of what they can actually do based upon certain rules that prohibit in some states having funding platforms. So it's really pass the hat in a local way, and it's not what Title III is for. Title III is to take the sale of securities online in a centralized, standardized way and make it easier for entrepreneurs to raise money. And if you can't do it through a funding platform, which most of these states don't permit, and even if they do, it's controversial. NASA, which is an umbrella organization, is against that. They are sending off very bad body language at most states through the securities departments to limit that activity. And so a lot of commercial people who speak to their lawyers, and the lawyers say, listen, why do that? It's not a lot of money. You're going to get into trouble anyway, so don't do it. Wait for Title III.
Great. All right, Keir.
If I could just add to that. I think another reason why you're not seeing a lot of interstate movement is that the laws themselves in many instances are drafted by people who understand, they're drafted by legislators as opposed to attorneys. So when it actually comes down to doing the administrative portion of actually going through the process, they get a lot of stopgaps. For example, the requirement to have an escrow that's chartered, an escrow bank that's chartered within that state, and then they can't find one that's actually working. So that's what's pretty much stalled Wisconsin completely. So there are a lot of impractical language in the statutes themselves, which are actually stopping it from working too.
Great. Keir, let me turn to you now. Let's talk a little bit about a part of the Jobs Act that probably gets the least attention and coverage, and that's Title IV, which deals with Regulation A+. So give us a little overview there, but also, we were talking outside, I'd be interested in your thoughts on Title I of the Jobs Act as well, or the so-called IPO on-ramp.
Okay. And I think it's appropriate that the Reg A part is last in this list because, in my view at least, let me backdrop. So under the Securities Act, there's a provision that says that allows fundraising for small offerings, limited offerings up to $5 million. And the current Reg A that's on the books, that's the law right now, is basically the only exemption. Oh, it's one of the exemptions that's based on that provision in the Securities Act. And I think at the time that Reg A was adopted originally, the thought was some of these provisions are going to allow companies to do effectively mini IPOs. They allow a company to do a test the water document before they actually commence the offering. There's some investor protection in that there's a mandated disclosure document that has to be submitted to the SEC once you decide you want to do an offering. And there's an obligation to tell people what you did with the use of proceeds afterwards. And to, I think, everyone's disappointment, Reg A really wasn't used very much historically. And so when Congress was thinking about what changes should be made to the exemptions for private offerings, one of the ideas was, well, maybe we ought to facilitate more and bigger offerings under Reg A by raising the cap for Reg A offerings from $5 million to $50 million, so that if you're going to go through the cost of doing one of these offerings, you can actually get a decent amount of money out of it. And so to that effect, the SEC's proposed rules that would basically set up a two-tier system, one tier that basically reflects what you currently have, which is a $5 million offering approach, and then a second tier that's kind of like a mini IPO that allows you to raise up to $50 million. But there's a lot of hair on it. And I think it'll be very interesting to see what happens when the SEC comes back to these rules. They've proposed them. They got a lot of, I think, very good and thoughtful comments. And now I think the staff is really struggling with what they're going to do with some of those comments, particularly around what kind of disclosures should a company that raises $50 million under this tier 2, what should they have to disclose to their investors after the offering is done? And just as an aside, and then I'll come to the EGC's point, just as an aside, when you look at the Reg A offerings that are being done now in the context of crowdfunding, and there are some, Fundrise, for example, is a platform that uses Reg A offerings for a lot of its offerings. If the idea is that you're saving money and saving time, well, some of those offerings have taken years. I looked at one this morning preparing for the panel where it took them almost 2 years to get through the process. And in terms of saving money on lawyers, well, they hired my good friends at Melvin and Myers, which are very, very good law firm, but not cheap because it's a complicated process. You have to have good counsel to do it. And so at the end of the day, I'm still somewhat skeptical about whether or not the changes that the SEC's proposed are actually going to have the impact that was desired. to address the Title I point. So one of the other provisions, in a brilliant stroke of strategy on the part of Congress, they included in the Job Act.
Did you say brilliant
I
stroke
did. It's
from
very
Congress?
rare. You should tape record that, 'cause I don't say it very often. But they included self-affecting provisions in the Jobs Act for emerging growth companies. And the idea was to create this new on-ramp, a shortened on-ramp, for companies to go public. And one of the things that Dan and I were talking about was that among the various provisions included in the Jobs Act that we're talking about today, which are the most effective, and in my view, just looking anecdotally at what's happened in the market since the Jobs Act was adopted, you see a lot of companies coming through as EGCs conducting IPOs. Just to use our own anecdotal experience, you know, if you look last year compared to this year, companies were looking at the new provisions, thinking about whether they want to do IPOs. You didn't see nearly as many. This year, just in the first couple quarters of this year, you had more IPOs done in the first half of this year than you saw the last 2 years combined. Part of that's the market, but part of it is the changes that were included in the Jobs Act. And what we're seeing when we talk to clients, and I'll end with this point, is that for clients that are eligible to take advantage of these new EGC provisions, doing an IPO is a lot more attractive. Because one of the things it does, it says you can, even though very few people do, have fewer financial statements that have to be included in the document. You don't have to provide as much executive compensation information, and most importantly, you can file confidentially. And those three things, even if not everyone takes advantage of those, I think have attracted a lot more companies to seek the the IPO route than would have been the case absent the Jobs Act.
And I want to come back to this thread at some point too, thinking about the interplay between public and private markets, which is a really interesting piece. You know, private markets are getting larger. Will public markets reform to be competitive? So with that, let me go to Brian. Brian, talk to us a little bit about the current environment for peer-to-peer or online marketplace lending.
Yeah, so peer-to-peer lending is essentially the disintermediation of banks in traditional lending for large finance, for debt refinance, for student loans. Virtually every aspect of financing and borrowing that borrowers undertake is moving to an online process, and it's more moving to online platforms that are not banks. So many of you have heard of Lending Club, Prosper. Some of the other platforms are On Deck, Funding Circle. These are peer-to-peer platforms where people can go apply for a loan and get funded without the bank process effectively intervening. Peer-to-peer is not new. It's been around for 6 or 7 years. However, recently it's gained steam because bank regulatory capital rules have effectively shut down lending to small businesses and to individuals absent the credit card markets. And so you have a company like Lending Club or Prosper that effectively is able to thread the needle through 5 regulatory regimes. They are not banks. They use a funding bank in most cases if it's a consumer loan, but they themselves don't have bricks and mortar branches. They don't take deposits. They don't have any of the issues with respect to compliance with bank regulatory rules. They're not broker-dealers because they issue payment-dependent notes from their own balance sheet, and as an issuer, not required to register as a broker-dealer. The loans that they buy off the platform are not considered securities, so they're not an investment company, and they no longer give investment advice to clients, so they don't need to register as an investment advisor. So you have everything except for the securities registration aspect, which they do file S-1s and 424B prospectuses for the securities they issue, but that's only because they choose to go to the public. If they were to choose to go to a private placement market where all the investors are accredited investors, and they could easily do that on a demand basis, then they wouldn't even have to file public reports, and they could essentially be a private platform. And except for Lending Club and Prosper, virtually every platform is doing it on a private placement basis. So the environment right now is very robust. Borrowers are able to borrow at rates that are lower than their existing obligations in most cases, or they're getting access to immediate cash that they wouldn't have access to before on 2 or 3 days basis. And on the investor side, compared to other fixed income products, you're seeing a great deal of yield being obtained by investors, all the way from small individuals to IRAs to hedge funds, private equity funds. There's a great oversubscription bid on the investor side for peer-to-peer.
Great. Okay, so now let's move on to this next section here. And at first, I'll tee this up for Doug, Anthony. in no particular order. First, what have we been seeing with respect to developments in 506C markets? I know real estate has been a fairly hot sector as well. Tell us what we've been seeing, and then from your perspective, what are the key legal considerations, whether they be for investors, platforms, or issuers, the company is seeking to raise capital through 506C? So either one of you can start us off, and I'm just interested in both of your thoughts on this.
It's rare that lawyers don't want to speak, but okay. No, I think in the 506C market, you're seeing some of the lead players being the real estate sections, the realty moguls, the fund rise. And I think that's because from an investor perspective, it's one of the easiest to understand. You're investing in something tangible, real estate, people can understand it better. In terms of concerns, there's concerns from both ends, especially when it comes to a peer-to-peer lending or a debt type of crowdfunding investment. It's that a lot of the sites, you have to make sure that what you're getting into as an investor, are your assets secured, or are you just getting what are referred to as payment dependent notes? It may look like you're getting something that's secured when in fact it's the portal that's secured and they have an asset-backed loan, but what you're investing in, yours is just unsecured paper. So it's definitely, you need to look through to make sure and understand exactly what it is you're getting involved with from an investor standpoint. From a portal standpoint, you want to make sure that you are doing the documentation correctly to get whatever security interest it is that you are being granted, that you're doing correctly, especially when it comes to real estate, that you're doing it according to correct state laws, recordation laws, things like that, to make sure that your interests are properly perfected so that you actually do have security in what you think you do. And in terms of raising money from an actual issuer perspective or developer perspective, I mean, this is a fantastic source of capital that you can more readily use. And what you're seeing in the market here is you can actually get real estate developers who are able to build on spec, which a lot of banks still don't lend on, still don't want to lend on. So this is one of the primary sources of capital for those looking to pick up on the kind of backlog of real estate projects and produce on spec.
Tony's right. I mean, the real estate has really skyrocketed over the course of the last 12 months since Title II went live. The venture model, though, is still alive and well and performing and raising lots of money both domestically and internationally. The big issues in 506C, and from a regulatory point of view, we've seen it, you have to make sure that you take the accreditation process very seriously. You don't get to just do 506C because it's an easy way to raise money online, whether it's real estate or a venture, if you don't have a proper process in place to accreditize the individual investors. There are a variety of different service offerings that are both internal and external for a funding portal to avail itself of in order to do that accreditation. But that is the first thing that regulators are looking at when they look into 506C platforms.
Can I just add one thought there? And since this is a legal panel, it's kind of a warning thing. On that point, I think when 506C first became law, there were all these questions about, you know, whether it was going to change the private placement market and what level of enforcement the SEC was going to employ with respect to people looking to take advantage of 506C. And it's interesting. We've seen several at least enforcement cases being brought. Being in several investigations being brought by the SEC where they thought that someone's accreditation process wasn't adequate. So certainly for the platforms and the audience, I will definitely think about that. There's lots of guidance out there, but I think being careful is more important than just getting the deal done.
Before we open it up, I mean, the only thing I'll add is more times than not, both the state and federal regulators whose reflexes to inquire have turned out to be incorrect in their inquiry, that in fact the funding platforms have more than adequately responded to the requirement to have the accreditation, and in short order those investigations have been shut down. So it's a bad regulatory reflex, but it's a chilling effect to the industry, and that's really the primary purpose for the investigation. Moving along though, the other thing to keep in, and that's why I say that, because I'll be politic here. I'm a fan of what's going on in Title II. I think the industry has policed itself well by and large. I'm sure there's some bad actors out there. I would just encourage regulatory restraint. The next thing in 506C land, though, is make sure as a funding platform you have counsel, or those of you in the room understand the distinctions between what revenue model the funding platform is employing. Is it a broker-dealer model? If you're taking a commission off the top, there's no way around it. You have to become a regulated broker-dealer. It's the sale of securities, and you have to do it. If you want to pursue a venture capital, private equity, or investment management sort of business with a 2-in-20 model, which has potential exemptions from the broker-dealer and the RIA models, be very careful. It's not as simple as following the revenue. There's also, you can't structure deals, you can't provide advice, and state and federal regulators are watching closely, and if they find fault with what you're doing, even if you're doing it largely correctly, because of the high-profile nature of the funding platform business, don't be surprised if you get a phone call.
Doug, just real quick on that point, can you just explain a little bit more how these syndicated models are being structured?
Certainly, whether it's real estate or venture, the funding platform is facilitating the introduction of investors to deals that are posted to the site. They then take the investors typically offline into a special purpose vehicle, which is either an LLP or an LLC, and an affiliate of the funding platform becomes the managing member of that funding vehicle, the SPV. And then, like any venture fund, hedge fund, or private equity fund, they get performance-based compensation paid out over time for their helping to facilitate the deal, structure the deal, diligence the deal, and then the ongoing monitoring of the deal. And they can get 2-in-20 as it's referred. There's some no-action letters out there that people somewhat misinterpret. There's some funding platforms out there that don't take 2%, even though you can take the 2% as long as it's paid out over time for your future efforts, not tied to the actual raising of the capital. But make no mistake, these are not just, oh, I choose A or B. You better make sure that you actually have the skill set to be a fund manager. You need to diligence the deals. You need to monitor the deal after you've put the money in, and your money is earned over time with the performance of the underlying investment opportunity. So don't just transition to that because you chose not to be a broker-dealer. You'll find a whole world of hurt because you don't have the appropriate infrastructure and skill set if you do that.
One thing I'm sorry. The difference up till now between 506C, which is the new advertised private placement, and B, which is the non-advertised old rule, is relatively modest. Advertised, you can only go to a creds and you have to verify or take reasonable steps to verify. It's going to get much tougher if the SEC enacts its proposed rules, which will require you to file an advance Form D 15 days before you start soliciting, and a closing Form D within 15 days after. And there's a proposal where you are in the penalty box and are suspended from Reg D offerings for 1 year if you fail to make those filings. So it is much more difficult in the future if those go into effect, and those are proposed as of last year, for you to reverse engineer or back into some other exemption once you've gone down the road of soliciting. For example, if you decided you're not soliciting and it turns out that you salespeople go out and do efforts which would constitute solicitation, you will not have been able to have filed the thing 15 days ago. So that's something to really look out for.
Great. All right, and so now moving to the peer-to-peer lending space. So Keir and Brian, I wanted to tee you up here. Talk us through recent developments in those markets. You know, everyone likely knows that Lending Club has filed for its IPO. And then again, let us know what are the key legal considerations for the various market participants in that space. So Keir, I don't know if you want to.
Sure. I'd say the biggest development's not legal. I think it's the fact that that I think peer-to-peer lending has become viewed as a legitimate channel for capital raising, or well, actually not really capital raising when you're talking about Lending Club and Prosper. There, it's really debt consolidation, but a legitimate channel for investment, certainly from the investor perspective. You know, if you look at Lending Club and Prosper now and compare where they are now versus where they were 3 or 4 years ago, literally it's kind of exponential growth in terms of just the volume and the sophistication of the investors on their platforms. In some ways, using the term peer-to-peer is really a misnomer when you talk about Prosper and Lending Club now, because while there are certainly still peers, retail investors on their platforms, the largest source of demand for those companies is clearly the institutional investors. And if you look at their filings, when they talk about the different sources of investors for the platforms, there's this reference, certainly in Lending Club's disclosures, about having these arrangements with investors who come in and basically having to turn off the spigot and say, we're only going to allocate up to X amount of loan volume on our platform to institutions because there's more demand than there is interest. The other thing I'll say, then I'll turn over to Brian, is that just from a regulatory perspective, I think the SEC has also become a lot more sophisticated in terms of the way they deal with peer-to-peer lenders. They have a set model and approach when they are dealing with Lending Club and Prosper. And I invite you to look at their comment letters, which are all public, to see the kinds of things that the SEC is focused on in terms of the way that those companies describe themselves, the circumstances in which they have to file prospective supplements and post-effective amendments and things of that nature. And if you're thinking about pursuing a public peer-to-peer model, I think that's one development to take a good look at.
Yeah, there are probably two big points that are worth pointing out on the peer-to-peer legal side right now. And really, peer-to-peer is divided into the consumer world, the small business world, and the real estate worlds. And the three really have nothing to do with one another. On the real estate side, people, and the business side, people want to see each transaction. They're evaluating the properties. They're looking at pictures. On the consumer side, it's more of a high-speed investment race. Institutions are angling for allocations from the large platforms. They're looking for total yield. They're not picking loan by loan. The platforms are going to do almost $1 billion this month in originations, which is a lot of $10,000 and $20,000 and $30,000 loans. So nobody actually picks an individual loan anymore. A lot of these loans get funded in less than 60 seconds. So the individual evaluation process is basically gone. The 2 points that I was going to bring up are, one, there is a disconnect between two cases that are pending. One is called Bill Me Later, and another one is a case pending in West Virginia courts that call into question the model of using a web bank to fund your loan, holding it for one day, and then buying it back from them. Each of these two platforms have extensive staff that do underwriting criteria. The loan decisions are essentially made by the two platforms, and they're sent on to WebBank, which has official final say. The courts have reevaluated this and are starting to look at whether this, what some people refer to as a rent-a-bank model, will hold up. And in the case of Bill Me Later, it was upheld, but in the case of a pending case in the 8th Circuit in West Virginia, it was not, which calls into question whether that will move forward and become a large case, which could upset the model. The other thing is the concept of preemption. And it sort of goes back to Reg A and it goes back to intrastate. There's a battle being fought between state securities regulators and the SEC right now. And there's actually 52 states in terms of regulation, if you count D.C. and Puerto Rico. They all have state securities regulators that want to not lose their jobs and not lose the ability to protect investors in those states. The government grants the SEC the ability to preempt in certain cases, including in the new Reg A, which is why everyone's very excited about it. The states are campaigning hard to fight that. In the concept of preemption, listed securities are fully preempted from state regulations. So if you do an IPO, your stock will be listed on NASDAQ and the New York Stock Exchange. You will have full preemption. You do not have to go state to state asking for permission to list their stock. Lending Club has asserted that because the borrow payment dependent notes are pari passu or senior to their common stock, that once they do their IPO, they're going to have full preemption on all of their payment notes. And instead of the 25 or 30 states that they currently lend to, and I have a slide that shows a map, they'll be able to go to all 50 states. And so the issue that some states have raised is, well, hold on, a payment-dependent note is very channeled, it's segregated. There's no liquidation scenario in which a holder of a payment-dependent note would get paid ahead of common stock if the company were to liquidate. And so there is still an open question as to whether you will have full preemption and whether investors will be able to invest in payment notes once the company lists its common stock.
So let me do this. I want to try to keep us on time here. One of the key topics that people bring up is the possibility of developing secondary markets around all of these different types of crowdfinance tools. I'm curious your all thoughts about the current legal frameworks. Does it facilitate, permit that kind of development of secondary markets for the various tools that we've been talking about? And anyone can feel
I
this.
actually have a comment on that. I don't think the current regulations permit for that type of secondary market right now. And prior presenter, it's the lack of information. The model of a market is defined, you define the price based on the available information of a company. And under the current rules, under the accredited investor model, you don't have to provide ongoing financials. Maybe with the Title III, you'll have to provide the ongoing financials. But without the ongoing financials, it would be hard to develop an actual value for each of these private placements, which is why there hasn't been one before. It's trying to define it. And when you're talking about building a secondary market, there's no impetus for the companies themselves to provide that information if they don't have to. Unless making their equities liquid somehow benefits them, they're not going to go through the hassle of making their financials public because it doesn't benefit them. So then you're left with, well, okay, now how does the investor who now wants to sell his securities get that information and get it valued? And that's where the disconnect is, and that's why it's very hard to create the secondary market is that lack of information and lack of basis. So even while you can get independent third-party evaluators to kind of come in and say, this is what I think it's worth, it's still an imperfect market because one person can say it's worth this and the other person could say it's worth that. And until they can find a way to make it beneficial to provide this ongoing financial information from a regulatory standpoint, I don't know how you create a basis for private placement value that is somewhat standardized enough to have a secondary market.
But to be clear, Title III is a private placement into a private company, even though it's called, it's got elements that look and are characteristics of a public offering. And let's not confuse the issues. It's a private placement. They ought to be sold as private placements, and there should be no suggestion of secondary trading, even though there are those in the room who are working on helping facilitate that. And when and if that happens, great, but it's a private placement, it's an illiquid investment, and more likely than not, you're going to lose your money.
And Title III has Title III actually has a 1-year lockup as part of the statute, right?
And by the way, I promise an uplifting panel here, Doug. So
from a legal panel,
Title III is not going to get you there, unfortunately.
I think that you have to see some sort of secondary market develop because these are all buy and hold products. They're lend and hold, 3-year, 5-year term. There are a lot of investors that are currently shut out of the marketplace because they don't have that period of duration. What you will see is the emergence, I think, of alternative trading systems, of second markets and shares posts and other similar that will try to create this market. The problem is that there is too great a diversity of assets out there. It's easy to say common stock of Facebook is something we all know what it is and can value, but if you have thousands of loans per day that are being issued, or you have companies that are issuing shares in multiple series, getting a standardization, putting a QSIP on it, putting it into a hands of where a broker will be able to value it and create a statement for it, that's the big challenge now. And until you see that, you're going to see either people holding these assets for an indeterminate period of time. Some of these real estate platforms, you have no say on when you're going to get liquid on your asset. You're investing into an LLC, and there's a manager who is running the property, and they'll decide when the exit is and for how much. But I think that in the other assets, you will see some sort of trading soon.
All right, we've been flashed our 5-minute warning here, so I want to run through a couple of more points. quickly. So this one, everyone keep your remarks short, but I want to run through the panel. If you had a magic wand, what is it that you would want lawmakers or regulators to be doing in the next year or two? I'll start with you, Doug.
Move forward with Title III with the proposed rules that you came out with October 23rd. Notwithstanding the fact that there are issues there, you have a mandate to move forward, move forward.
I think that in terms of the magic wand, the regulators seem to be somewhat compliant with what's going on in the marketplace. You really have an absence of people complaining other than people complaining that the rules aren't out. As long as the rates and everything else stay static, you have a relatively happy investor base and a happy borrower base. So I think that not overreacting to certain issues that come up or imagined controversies that Doug mentioned, I think that would be sort of my wish.
If we're talking fantasy reality or fantasy or reality,
your choice.
Fantasy.
You got a magic
wand. I mean, if you could talk anything, I'd rather see the government be like the UK and actually create rules specifically designed for this, rather than trying to make archaic rules work for it, and to treat debt different than equity because they are different products. Since that will never happen, or at least not in the near future, I would like to see them, yes, go through a Title III and as well just keep an eye, a more cautious eye, as opposed to jumping in onto every little aspect that they see, and try to let the market develop without trying to tear it down. Help it, issue no action letters, work with the companies instead of trying to enforce every little thing, because we're talking about a blind area and we're going to need their assistance and guidance because they're not providing it. So.
Yeah, I agree with that. Mine doesn't actually require a magic wand. I think that at the end of the day, if the SEC and soon the CFPB and the state regulators were to take a more rational and I think more capital raising, pro capital raising approach in terms of enforcement and regulation, I think that'd be very helpful for the market. I've been in meetings with the staff where you say, okay, the rule says this, we've done that, it's completely in line with what the rule says, and they say, no, you still can't do it.
To show that lawyers can have fun here, I'm going to wrap up with our lightning round. What I'm going to do here is I'm going to make a declarative statement, and then I'm going to offer you either a movie or a song title for you to agree or disagree with my statement. It'll be clear. So, Keir, you'll be the first guinea pig, and we'll run down the line. So regulators and policymakers understand how technology and the internet can help increase market transparency. Brave New World or No Country for Old Men?
No Country for Old Men. Pessimist.
Anthony.
Oh, No Country for Old Men. I 100% agree.
I think it really depends. There are
spoken like a.
I think in most cases it is actually a brave new world. There are regulators that get it, that want to work with the public, and I'm not just saying that because some of them might be in the room, but but I think that there is a culture, at least, of constructive cooperation that seems to be emerging, mostly prodded by the legislative branch.
Doug.
It's No Country. It's the No Country one. However, what I say to folks,
no, we don't have time for qualifiers.
It's a brave new old country.
If they look at what's happened the last year, everything that they said was going to come true has not.
All right, next one. The internet provides new and more effective ways to perform due diligence or assess risk related to securities offerings. Raging Bull or Much Ado About Nothing? Doug, we'll start with you. No qualifiers, just titles.
Then I'm not talking.
I think he pled the fifth there.
It's new ways.
I say Raging Bull.
Raging Bull.
Raging Bull.
All right, last one here. Investors through online platforms understand the risks involved and the nature of early stage investments or peer-to-peer lending. Don't stop believing or living on a prayer. Keir, we'll start with you.
Living on a prayer, that's easy.
Yeah, that's easy, living on a prayer.
I would say mostly living on a prayer, but on the institutional side, the investors have very sophisticated algos and actually understand this more than the issuers.
Yeah, that's perfect.
For Title II, it's the first one.
Thank you all very much. Appreciate it.